Inflation has dominated the economy this year, and while there are signs it is beginning to cool, there are major concerns about where the economy stands heading into 2023. The Fed raised rates for the seventh consecutive time this week, and consumers also saw a slight decline in prices last month compared to the same period last year. So for more on the state of the economy, let's bring in Lori Bettinger. She is the president of BancAlliance, the former director of the Troubled Asset Relief Program under the Obama administration. Good morning to you. Let's begin with the Federal Reserve raising interest rates, although slightly lower than it had done previously. Is this the sign we need that the U.S. is moving in the right direction, or do you expect more hikes in the new year that could potentially be higher?
Good morning. I think we've had a number of signs showing that we're moving in a better direction. I think you mentioned that we saw improved inflation numbers this week. They weren't perfect. We're still up 7% year over year, but compared to, earlier this year, we were up 9%. So that's clearly a big improvement. And I think that the Federal Reserve had certainly made its intentions clear, and many people expected this latest raise, which was, as you mentioned, only 50 basis points instead of the 75 basis points raises that we've been seeing, in prior months. But what we heard was that the Federal Reserve said, we're not done. We don't think that, the economy's fixed yet. We don't, we just have one of many Band-Aids, and we're going to keep an eye on conditions, and we expect interest rates to increase. And when the Federal Reserve says they expect interest rates to increase, they control a large part of that market. So, it's not just like someone else telling us that. So I think we're making progress, but there's still clearly a lot of concern about different factors in the economy, chief among them inflation.
Right. Look, the biggest financial decision our viewers will make is buying a home. And we know that while the Fed hiked interest rates, mortgage rates apparently are slowly coming down, still historically, I guess, relatively low, but coming down. What are some factors contributing to that dip in interest rates? Because that's very significant.
It is significant. And it's interesting, the Federal Reserve, they control this one rate called the Fed funds rate, which is really what banks lend to one another. And then there's all of these other different interest rates, which affect us so much more directly as consumers that are tied to that rate. Some are tied more closely than others. And the mortgage rate is really tied to this 10-year treasury. And that reflects what we expect to see in the future. And, I think a lot of people think that this time of high interest rates isn't going to be around forever, maybe not even that long. And so mortgage rates have started to slowly come down. Now they're closer to 6% than the 7%, we were talking about fairly recently. And I think that, that's a great thing for home buyers. Maybe it makes prices slightly more affordable. But, as we hear so often, houses are still very expensive. So it's still much more expensive to buy a house now than it was, let's say 6 months ago. But the interest rates, they reflect more expectations about longer term rates than necessarily where the interest rates are today or what the Fed might do next month. And we're really seeing that play out.
Yeah, so many folks living at home with their parents right now, saving cash, but I'm sure they'd rather get a place of their own if they could. Lori, great to see you. Thanks so much for joining us this morning.
Great to see you. Thanks.